If you're approaching retirement, or maybe you're already retired and you have $2 or $3 million or more in retirement assets, you might be on track to be paying way more in taxes over your lifetime than is necessary. And this can add up to real money. I'm talking about tens of thousands or even hundreds of thousands of dollars in unnecessary taxes over your retirement. And what's more is that a lot of people may not even realize this until much later in their retirement. And by that time, it may be too late to do anything about it. So you might recall that last year in 2025, there was some brand new tax legislation that was passed called the One Big Beautiful Bill Act. And what that did, among other things, was it made those tax rates, those low tax rates that we had from the Tax Cuts and Jobs Act, they made those rates permanent. Previously, before this bill was passed, they were set to sunset at the end of 2025. So if this One Big Beautiful Bill Act was not passed, we would have all seen higher tax rates across the board in every level of income. And so the planning that we were doing back even a year ago is completely different than what that landscape looks like today. So in this video today, I'm going to be walking through another one of our hypothetical case studies, getting into our eMoney financial planning software and showing how we can use a number of different strategies that can reduce our hypothetical clients' overall taxes pretty significantly over their lifetime. I'm talking about a couple $100,000 or more in these tax savings over their lifetime by doing things like Roth conversions, by unwinding some embedded capital gains that they have inside of a non-retirement account. And how do you structure that? How do you coordinate that with your other sources of income, and which accounts and when do you take withdrawals from your various accounts? So we're going to get into all of those details here in today's video and walk through that. These hypothetical clients also saw a pretty significant increase to their total portfolio assets over their lifetime, primarily because of some of the tax savings that we were able to work out here. But real quick though, before I get into the details of today's video, my name is Bill Lethman for MoneyEvolution.com, and I created a brand new resource. It's called the Retirement Tax Planning Guide. And in there, I go through 10 specific strategies that you can do. Some of those are going to be before you retire. Some of those are going to be things you're going to do in retirement after you retire. And we're going to be walking through how you may be able to utilize some of those strategies for your situation. I'll also talk about some of the common tax traps that really can sneak up on people that can cost you additional money. Things like what happens after required minimum distributions kick in and it maybe pushes you up into a higher tax bracket. That may also trigger something called IRMAA, which is the income related monthly adjustment amount, and that could literally double or even triple or more some of your Medicare premiums that you're paying. If you're trying to unwind some of those capital gains from a non-retirement account or have a lot of investment income, you can also get hit with something called the net investment income tax. That's in addition to your 15% long-term capital gains tax rate, whatever that may be, but it's another 3.8% tax. So we're going to show how we plan this out in the software, and we're going to be showing how you might be able to avoid some of these things and how to coordinate all of these different things together. So again, there's 12 of these strategies in the guide, and we got all the details there. So we'll put some links down in the description below if you'd like to download it. It's completely free, and it'll also be over on our website at MoneyEvolution.com as well. So check that out. Let's dive right into our case study here. Okay, so let's hop in. So we're inside our financial planning software, and we're looking at the Steve and Kelly Sanderson hypothetical case study, and we're using our eMoney financial planning software. That's the tool that we use for all of our financial planning. And again, their situation is going to look different from your situation. You may have much higher assets or maybe a lot lower assets, but you're going to understand here as we go through the video the framework that we use to sort of map all of this out and really look at what are some of those optimization strategies for how we take the withdrawals, which account we take from first, and then how we do things like Roth conversions and keep ourselves out of some of those higher tax brackets later on. So to give you a quick background on Steve and Kelly, they have some pretty good assets. They have about $4 million or so, actually a little bit over $4 million in their traditional bucket. They also have a little bit over $2 million in a brokerage non-retirement account with a pretty large capital gain embedded into that. So they have about $2.2 million in that non-retirement account with $1 million cost basis. So if they sold everything, they're sitting on $1,200,000 that would have to be reported as a capital gain. So we're going to look at how to do this, how to structure that in terms of when do we sell those stocks or securities that are at those gains, when do we take withdrawals from the retirement accounts, and where, if anywhere, do we start putting in things like a Roth conversion here. So we always want to begin every financial planning process with a good roadmap, and the roadmap that we use here is called the cash flow report, and this is all about money coming in, money going out, so we can see it all here. Some years are going to be bigger, some years are going to be smaller. You may have years where maybe you're taking some larger trips, so that's going to increase your expenses in those years. If you're taking larger withdrawals from a retirement account, the taxes are going to be automatically calculated within the software, and that's going to be illustrated here as well. But the one big takeaway that we want to get from this is understanding what is that net cash flow. So if we have money coming in versus money going out, that difference is going to be the amount of money that we're going to need to take out of the portfolio every year to meet their retirement lifestyle needs. And that's always where we want to begin every single retirement plan. So we can see that this second column from the right is giving us that indicator as to how much money is going to need to be withdrawn from the portfolio. So they have some pretty high expenses. They need roughly about $20,000 a month, plus the taxes and other miscellaneous things to meet all of their retirement expenditures that they want to do. But again, they have the assets to do that, and there's no issue for them in retirement to be able to meet some of these goals. One of the things that I'm not going to get into a lot of detail in today's video, but you always want to be thinking about having a buffer in something that's safer. We usually recommend 2 years of your cash flow needs in something like a money market, short-term CDs, money in the bank. That's money that you can access and get at even if the markets are down, so you don't have to sell those equity investments when the market may be going through a correction. You also want to have another 3 to 5 years in sort of a middle bucket. That can be a little bit longer term, but still much more on the conservative side. That may be a bond or CD ladder, some other fixed income investments, things like that that are going to give you another 5-year window, because some market downturns do last longer and it can take years to recover from a more significant market downturn. So we can see they have some pretty healthy cash flow needs, about $250,000 a year in the first couple of years. As some of their income starts to come in, they have virtually no income right now because they don't have Social Security turned on, they don't have a pension, no other sources of income. But we can see over here in the income flows column, the only other source of income that they have coming in that's predictable is going to be that Social Security benefit. So we see a partial year coming in when Steve turns 67, the full year for him in 2029. And then a couple years later, Kelly will start to get her Social Security benefits, and then that increases that a little bit. So they end up right here in 2031 with about $91,000 of predictable income. So that does drop their cash flow need, how much money they need to take out of the portfolio, from about $250 down to about $170 or so. But again, those are the things we want to be thinking about. And you even want to be putting this plan together before you retire, because you're going to want to start building up those cash flow buckets even before you retire, because things might be going along just perfect and the market may be going up, and then you don't want to wait until retirement, because if that first year or even the first couple of years in retirement ends up being a market correction, that could catch you off guard, and that could be a really difficult hole to kind of dig your way out of there. So the other thing I'm just going to touch on here for a second, I just made another video about this not too long ago where I talked about where do you put that cash flow bucket. So I mentioned that they have $2 million in a non-retirement account with a $1 million cost basis, and they also have $4 million in that traditional retirement account. So what I would generally recommend, and Steve and Kelly were in this situation while they were working, they were in very high tax bracket. So if they sold any of those investments from that non-retirement account, that would have triggered obviously capital gains. It would have pushed them up into a higher tax bracket, potentially even causing them to go from a 15% capital gain rate to a 20% capital gain rate. But it almost certainly would have triggered something called the net investment income tax, which is an extra 3.8% tax on those gains. So if you don't want to sell those investments while you're working in that non-retirement account, then build up that cash reserve in the traditional retirement account. And then when you arrive at retirement, as long as the market's still doing well and those investments haven't gone down in value, you can tap into those if that's what the strategy is and makes sense for, to take that money from the non-retirement account. But if the market is going through a correction, you can just simply take some of those early years of distributions from your traditional retirement account. And so that's something that, again, I have another video. We'll put a link probably down in the description below on that. So this cash flow map is going to be really important. Most of our clients do not have any issue with being able to retire, and there's no issue really with running out of money unless there's some really major catastrophe or something like that with the financial markets. What we want to generally look at here, and we're looking at this detailed withdrawals page, and that is going to see what is the withdrawal percentage every year. I subscribe, and a lot of people subscribe to that 4% rule. I usually like it to be a little bit less than that, because even the 4% rule does have some risk, and there are some situations, if you look back at historical data, that even taking 4% in a really, really bad market could still lead you to have some issues later on. But their withdrawal rate is very good here. It's 4% in the first year, a little bit higher, then it drops a little bit, and then by the time they're getting Social Security coming in, that's dropping down below 3%. So no real issues there. So as we start to put this together, one of the things we want to look at first is we want to just kind of take a quick glance at what their tax situation is looking like over time. And that's one of the things, a lot of our clients came to us and they were using other software or putting together these really complicated spreadsheets. And on the tax planning, that's really an area that becomes very difficult to really grasp all of those different moving pieces and see what that's doing to their tax rate, not just now, but what is it doing over time. And so we have a really nice report that gives us an idea of this. And because the software that we use, and most software is going to default to taking money from the non-retirement accounts first and then tapping into the traditional and letting those grow, it's going to basically start withdrawing or liquidating some of that money that they have in that non-retirement account, triggering those capital gains. But because those are taxed at a preference rate, some of that is actually going to get taxed at 0. Some of it's going to get taxed at 15%. And they're not going to get up anywhere close to that 20% rate, but they might actually be hit with some net investment income tax. We'll take a look at that in a second here. So their effective tax rate, or their bracket essentially, is going to be very low in those early years. And then by the time Steve is at that age 75, when his required minimum distributions kick in, you can see we jump all the way up from a 12% bracket up to a 24% bracket. And again, that's going to trigger other things like IRMAA and things like that. And so that stays well into the 24% bracket throughout most of their retirement. So a couple of options that we're going to start to look at here. So one of those is going to be, can we take advantage of liquidating that non-retirement account and maybe even get a 0% tax rate on that? And if not, we can certainly keep ourselves in a 15% tax bracket versus doing a Roth conversion or taking withdrawals from a retirement account like that traditional bucket and then having that taxed at the ordinary income tax rate to bring that down. So we're going to look at a couple of different scenarios here. And I did a couple of these already. So let's take a look at let's just look at some Roth conversions here. So there's always going to be some low-hanging fruit. So if we know we're going to be in a 24% bracket later, then maybe targeting a 22% bracket for a lot of people is what makes sense. And if you can convert money from a traditional retirement account to a Roth retirement account and do it at 22%, keep yourselves out of a 24% bracket, that may not seem like a whole lot, that 2% difference, but that stacked up on top of each other and doing that year over year has a very big compounding effect here. So we can see that doing Roth conversions in the 22% tax bracket ends up saving Steve and Kelly $359,000 in cumulative taxes over their lifetime, and it actually increases their total portfolio assets by $709,000. Beyond that, there's actually another big benefit of that. Not only is the total of all of their assets bigger because they're saving that money in taxes, but the distribution of those assets is also going to be much better as well. So when we look at a report called Assets by Tax Type, we can see what that looks like here. And doing those Roth conversions up to that 22% gives them a much bigger representation in that Roth bucket. So the Roth is going to be that orange bucket, and with just the $25,000 that they have in there right now, if they didn't do any of these Roth conversions, that's just going to grow a little bit over time. And still, the bulk of their money is going to be in that non-retirement account bucket. Another very interesting thing that happens here, though, is if we look at these blue bars right here, these are our taxable assets. So they started off with $2.2 million, and again, with the default in the plan and taking out that money from the non-retirement accounts, but leaving all of that money in the traditional bucket is going to force those RMDs. And those RMDs, even though they need a pretty good amount of money for their living expenses, they're still going to be greater than their required minimum distribution. So all of that money kind of gets stacked up over here, and then we see that non-retirement account bucket growing pretty substantially because of those excess cash flows that are caused by the required minimum distributions. So this really looks pretty good. It does bring down a little bit more sharply in the early years, that money that's in the non-retirement account, but we still end up with a fairly decent amount there. But again, not only, and this is going out to Kelly's age 95, not only do we have a lot more money, $11,500,000 versus $10,800,000 in here, but we also have $8 million in the Roth compared to just $128,000 in Roth. So that's going to be better for the kids, better for the beneficiaries that are going to inherit a Roth account versus an account that's got all these taxes embedded into it. And they brought down their traditional bucket by about half, from $4.3 million to about $2.3 million. Even if we looked at this and said, okay, let's look at it at age 82 and age 80. There's about the same amount. Actually, it's about $1 million more by not doing the Roth conversions. So there's one of those things where on paper, there's a little bit of a break even where you're going to have to kind of claw back some of that taxes that you paid. But it's no different than paying off the mortgage on your house. It doesn't change the value of your house. But if you paid off your mortgage, now you own your house completely, as opposed to your house minus whatever mortgage you may have had. So in this situation right here, there's about $1 million difference, but there's $4 million in Roth, $4 million in traditional versus $61,000 in Roth and $7 million in traditional. So by the time we net out the taxes on that traditional bucket, I think that even at age 82, they would still come out further ahead. And that's a good question or point, because a lot of people think there is an actual break even for doing a Roth conversion. But again, really, as long as our tax bracket when we do the conversion is less than the tax bracket it is when we take that money out, then you're going to be better off to do those Roth conversions here. So let's go back to our planning decision center here for a second. And we looked at a couple of other things. One of those was maybe getting a lot more aggressive, because again, they were hitting that tax bracket, that 24% tax bracket early on. So let's look at what we just looked at there. That's our Roth conversions at the 22%. And it did push us up later on into that 24% bracket. The other thing we need to think about here, and some people maybe need to think about it more than others, but if something happens to you or your spouse and you go from a married filing joint tax return to a single tax return filing status, that's going to basically cut a lot of those brackets in half. So in other words, you're going to hit higher levels of taxation at lower levels of income. Some people call it the widow's penalty. But that does kick in a little bit later, basically in their early 90s is where that comes in. But they're really not going to be too much into that 24% tax bracket. We do kind of hit that a little bit higher here at 94, and then we can see a little bit of that widow's penalty coming in here because we have both of their ages run out to age 95. Steve dies first, and then Kelly would be on a single tax return. We do have the ability to run what-if scenarios where we do a premature death of a spouse and really look at this. Sometimes that's something people want to do if there's a bigger age difference or there's some health issues that one of the spouses has, and we want to plan for what happens if somebody passes away early. So we're going to think about those different things there. Let's look at that if we got a little bit more aggressive, and now we're going to go all the way up to the 24% tax bracket. So what it does is it's going to save a lot more on taxes, $900,000 in tax savings, but it actually has a little bit lower amount of money in that total portfolio assets at the end of life by about $200,000. But we can also go back over to our assets by tax type, and what we're going to see, same thing we were looking at earlier, more or less, is we're going to do Roth conversions versus the more aggressive Roth conversions. So this is just 22% Roth conversions versus 24% Roth conversions, and we'll separate that by assets by tax type. So now with the more aggressive Roth conversions, we're actually getting rid of that traditional bucket altogether very early on, and almost all of the money, with aside from a small amount that stays in that non-retirement account bucket, almost all of that money is in Roth. So even when we look at end of life scenario, there's about $1 million difference, a couple $100,000 difference between those scenarios, but we have almost $10 million of that in the Roth compared to $8 million in the Roth on the other one there. So those are the things we want to compare and see, where are your feelings at? Some people feel like taxes are going to go up, and I think taxes will probably go up at some point as well. What brackets they'll go up for? Is it going to be just the higher brackets? Are they going to start to tax people that have larger IRA balances? Those are all things that we could not make any predictions on, because we're talking about 20 or 30 years of tax legislation that could come in, and who the heck knows what's going to happen over time on that. So this would be one scenario to kind of compare. The other scenario, and we do this for a lot of clients, especially when you have that large balance in that non-retirement account, there is an ability to take advantage of some of those 0% long-term capital gain tax brackets. So I mentioned it earlier. So for married filing joint, if you're just getting the standard deduction, you can have up to about $131,000 in total income, and that portion of your income that's attributed to the long-term capital gain is going to be at a 0% long-term capital gain tax preference rate. So that's something we can work out here as well. So let's hop over, and I did this. And what I did is I don't think that's something that most people are going to want to do every single year, but if we did it sort of on an alternating year basis, we could have 1 year where we try to capture that 0% long-term capital gain bracket, and then the next year we could do something like the Roth conversion and map that out. So let's look at an alternating year type of a plan here, and let's look at what that looks like on our taxes. So here, what we're doing is we're only doing a Roth conversion every other year, and in the other years, we're going to take a distribution and we're going to keep that tax bracket such that we can get that 0% long-term capital gain tax rate there. So we can see they're still doing about the same, targeting that 22% tax bracket, but doing it every other year. It does push us a little bit more up into that 24% tax bracket, but depending on what the makeup is of that non-retirement account and what your feelings are about the investments, you may want to use this. Maybe it doesn't have to be every other year, but maybe you can do it for a couple of years in the beginning of your retirement to sort of give yourself a little bit more of that cash reserve, and then do the Roth conversions in the other years. The other thing too is you can also maybe do some Roth conversions even after your required minimum distributions. That's something that a lot of people don't really understand or know they can even do. Doesn't probably make sense for Steve and Kelly because they're already in a pretty high tax bracket, but for some people, they can continue right on doing those Roth conversions even after they start doing their minimum distribution requirement there. But this does have a pretty nice outcome here. It still saves a very healthy amount of taxes, $188,000 in taxes, and it does increase their portfolio value by about $480,000. If we couple that with a more aggressive Roth conversion in those alternating years, and instead of going up to the 22%, we go up to the 24%, that's going to have a much bigger impact on that. So I think for Steve and Kelly, going up to that 24% tax bracket is going to probably be the appropriate amount of Roth conversions to do, because they do have such a large balance in their traditional retirement account. But again, everybody's going to be different. So again, Steve and Kelly started with about $4 million. So if you weren't really taking hardly any distributions out of that, by the time that money got to age 75, that could, depending on growth rates, everything, it could be double that amount. It could be $8 million by the time they get to age 75. The required distributions on that would be north of $300,000, $320,000 roughly on that money that would have to be forced to come out for those required minimum distributions. So now they're doing this alternating years here, and then we're doing this just till Steve gets to that age 75 when he's forced to start taking that money out. But that has a very nice net result. So as we're putting together these plans, I just really wanted to kind of highlight some of the different strategies and tactics that we use and kind of compare them to one another. Rates of return are going to have an impact. Some people may be much more aggressive with their investments. They might be expecting a much higher rate of return. By the way, inside of our software here, we do typically 5% for the hypothetical growth rate on the portfolio, and we do that across the board in all of the accounts. And the reason we do that, even though in reality you're much more likely to get a much different rate of return in the Roth versus traditional, for example, because you probably should be investing that Roth money more aggressively than the traditional. But by keeping the rate of return a little bit more conservative and keeping it uniform across all the different accounts, we're now isolating the tax benefits. So in other words, if we said the traditional account is going to grow at 5% every year, but the Roth is going to grow at 7% per year, well, there would be a huge advantage that would be shown inside the software from just moving the money from a 5% account to a 7% account. So we keep everything the same. That way, it's really just isolating and giving us what is that tax benefit for doing those Roth conversions here. And when we look at that assets by tax type, once that report pops up here, it will show us what the makeup of that portfolio looks like when we do the alternating years at the 24% and change that. And so still much more in that Roth bucket, but you're still stringing out that traditional bucket for basically the entire lifetime there, kind of drifting slowly downward there a little bit there. But we can see that even at age 83, there's $4 million in that Roth bucket compared to hardly any money in the Roth bucket. So that's going to be a transition that I think a lot of people are going to want to know and understand, and doing those Roth conversions. I think for most of our clients, that's something that definitely comes into the mix here to do some of those Roth conversions. Last thing I want to show you here as we get into this is we're going to look at the income tax report just to give you an idea of just how detailed some of this planning software is. And I'm going to show you what that looks like on a tax basis for doing those Roth conversions. So we can see there, those are the years we're doing those Roth conversions, so our income is going to be much higher in those years. But we can also see, too, that we were basically able to get to that 0% federal income tax because we were taking distributions or selling those securities that were in that non-retirement account, trying to keep ourselves under that IRS limit for the 0% long-term capital gain tax rate. Incidentally, if you do go over, it's only going to be the amount that's over that's going to be hitting that 15% rate there. So it's going to push us up a little bit, but $1,800 in tax, $5,000 in tax in a couple of these other years. Part of that is because of the Social Security benefits that they start to receive, so that's going to give them some ordinary income. That ordinary income is always going to get stacked up first, so you don't get this 0% long-term capital gain and tax preference rate if you have $100,000 coming in from a pension or Social Security, and then you try to do this on top of that. It's going to be ordinary income first, and then it's going to be your tax preference income. So, but we tried to do that and keep that tax rate pretty low in those years. And then you can see, even though we did have some bigger tax years early, it definitely kept the long-term federal income tax rates down. And this gets even more detailed than that. So right down to looking at what your adjusted gross income is going to be every year. That's going to be a key indicator or driver for some of the deductions, whether or not you qualify for things like the senior bonus deduction, or if you're going to get hit with IRMAA, or you're going to lose some other thing and get hit with some other stealth tax. That adjusted gross income is going to drive the modified adjusted gross income, which is what a lot of those tax thresholds are going to be based off of there. But we can see that what that looks like. So anyway, I hope this has been helpful to kind of give you some ideas and thoughts on here's some of the things you should be looking at as you go into retirement, and how do you piece this all together. It can obviously get very complicated because every time you change one thing, it's going to affect something else. And what is the impact on all those key metrics? What is it doing to your lifetime taxes? What is it doing to your portfolio? What's the makeup of that portfolio? In some cases, it really affects your cash flow as well, too, because those taxes are going to be calculated into that required distribution that you're going to need to take out of those investment accounts. So the more you pay in taxes, the more money you're going to need to cover not only your living expenses, but also those extra taxes there as well. So again, I'm Bill Lethman for moneyevolution.com. Check out our website. Check out some of the links down in the description below. We've got some other great free resources on our website, including our retirement launch kit. And check all that out. I look forward to seeing you back in one of our next videos. Thanks.